Good afternoon, everyone, and welcome to today's webinar hosted by KLG Business Valuators and Forensic Accountants. My name is Steve Cusimano, and I'm thrilled to be moderating this third installment of our webinar series, Valuing a Closely Held Business. I'm even more excited to introduce our two presenters, both thought leaders and experts in the field of valuation and forensic accounting. First, we have Lou Panariello, who's a CPA, ABV, and CFF, a partner with KLG, and with almost 2 decades of experience guiding attorneys, business owners, and financial professionals through complex valuation and forensic engagements. Lou's work spans matrimonial disputes, shareholder conflicts, estate and gift tax planning, and corporate transactions. He's frequently appointed by the courts as a neutral expert and has testified in high-stakes litigation, bringing clarity and credibility to even the most intricate financial matters. Joining him today is Joe Ammirati, a CPA, ABV. He's a managing director at KLG with over 25 years of experience. Joe's valuation and forensic expertise covers everything from family law and business damages to corporate litigation and shareholder disputes. He's also served as an adjunct professor at LIU, teaching fraud and forensic accounting, which underscores his commitment to both practice and education. And today, we're the beneficiaries, which is great. Together, Lou and Joe bring deep insight, precision, and experience to today's discussion. And with that, I'll hand it over to Lou, who's going to walk us through the agenda.
All right. I'm just going to show our disclaimer page just briefly, and I'll read it so that everyone's aware. The presentation is not intended to provide legal, accounting, valuation, or tax advice, should not be constructed as such. The information contained in this presentation does not represent the opinion of KLG as a whole, as it may relate to specific matters and should not ever be construed in that way. Any examples which Joe and I will be providing sort of demonstrative exhibits within this presentation, they are for illustrative purposes only. The materials that we're going to present are not to be distributed without the express consent of KLG or Joe or myself. So with that said, just a brief overview. What we're going to be talking about today in this final part 3 to our 3-part series. We've previously covered topics such as questions for management and documents that you need for business valuation. We went through the income approach and how to implement that. This presentation is going to go through the market approach. Specifically, we're going to go through the private transaction method. We're also going to go through the guideline public company method. And after that, we're going to get into what's kind of really the cherry on the cake for business valuation, the last leg, if you will, and that's valuation discounts. And specifically, we'll go through the discount for lack of control, commonly known as the DLOC, and the discount for lack of marketability, which is commonly known as the DLOM. So with that said, Joe will kick off our market approach.
Good afternoon, and thank you for joining us today. The market approach is that what it is? It's coming from the market. So it's a method that determines the company's value by comparing it to similar or recently sold businesses or publicly traded companies in a similar industry. This is, guided by the Revenue Rule in 5960, which is the definitive guide for the IRS when valuing closely held interest in businesses for estate and gift tax purposes. And it requires, the analyst to consider several factors, one being including the market approach. So in the ruling itself, it specifically mentions that, the following market-related factors should be considered: the market prices of comparable companies, that being like, what are these things being bought and sold for? If there is any prior sales of the company's stock, whether that was through buyouts or retirement of individuals or acquiring new partners or, kicking out old partners or shareholders. And then also looking at, comparable, public companies or private transactions that are occurring in the market to see what those multiples are yielding.
Just to chime in, when we talk about prior sales of the company's stock, which is actually the next slide, you should be looking at sales of whatever the stock is that you're valuing. So it's common for companies to have multiple classes of stock, class A, class B, class C. If you're valuing class A shares, when you're talking about prior sale of a company's stock, you care about class A share transaction. So Joe will get more into the detail.
Sure. So, typical to any valuation assignment, the analyst should always, in doing the interviews, and we touched on this early on in the first series, that they should always ask if there was any prior transactions that occurred within the subject company. This may or may not be a proxy for valuation because many things need to be considered. Was the transaction at arm's length or a duress sale? Was it a negotiated price, maybe or sweat equity deal? Was there any formal valuations conducted in that process? So the analyst should be inquiring about that and saying, okay, if there was a prior valuation, what is the validity of that valuation? Let's test that through either reviewing purchase documents, shareholders agreements, and if they did do a transaction, did it follow such the formula presented in the shareholders or operating agreement? Does it say that, your buyout's going to be based on a multiple or do other appraisers need to be involved? Should it be a formal valuation? Other things that should be looked at, even though, again, this is not part of the market approach per se, but again, it's using it as a comparable because we'll sometimes price out those, transactions. If there was a buyout agreement, they bought out a retiring shareholder. Maybe there's some sort of tax motivation why they structured it a certain way for the purchase price allocation, but we'll also want to price that out and say, okay, well, if you bought a 25% interest at $600,000, what was that based on? Was that based on just a return of their capital? Was it based on the value of the net assets? Was it based on a multiple of earnings? And then we can use that as a comparable when we do, look at transactions in the market to see if it's a good proxy of value. So segueing into the private transactions method, which is one of the two methods under the market approach. In this method, we're looking at actual transactions that were involving companies that were similar to the subject company and industry-wise. Think of almost like a restaurant valuation. So we're going to look to the market and transaction and databases we subscribe to, such as DealStats, BizComps, that track these transactions. This is information that's provided to banks or business brokers. So we subscribe to these databases, which help us, formulate what the industry is saying these market multiples or pricing multiples should be. So again, using a restaurant as an example, we'll look to, we'll walk through an example of this a little bit later, but we'll put in our metrics saying we want a restaurant with this sales between this range and between these dates and maybe in this geographical location. And it'll in turn produce a report for us that will list out all the different transactions from which we can analyze and review and maybe use as a basis in our valuation. Another big thing that we also, as simple as it sounds, is go to the internet. Let's look at certain, transactions, see if there's businesses for sale similar to us. Again, restaurants are an easy one to always, or pizza shops we can look at. Go to certain sites like Biz Buy Sell, see what local businesses are being bought and sold for, and sometimes they might list, relative information. What were their gross sales? What is the price they're trying to sell the business as, or what was their cash flow? And we can derive multiples from the market and see if they make sense. Another term that's widely thrown around is the rules of thumb. Again, this is, we have publications that we review that might be saying, restaurants are sold for 40% of revenue or 20% of market, EBITDA or sale or cash flow. And again, that might just be what we call rules of thumbs, but we'd have to look at the transactions to verify that information. But that's usually what sometimes you'll hear business owners refer to. I can get 5 times EBITDA or 20% of revenue. But we still, as analysts, have to analyze, see if that's a valid multiple to use in our valuation other than just, what someone said or hearsay. So, when an entire sale of these companies in these transaction databases, it's assuming that 100% of the company is sold. And that's typically is often structured as an asset sale. So there's 2 types of sales that could occur. A stock sale where someone's buying a stock of the existing company that's going to continue and, operate and have its same assets and level. Or there's, an asset sale where maybe the business owner is now exiting the, industry or the business and selling the customer list, its equipment, its sales. So when we look at transactions, most often they are asset transaction sales, and that's why we want to make sure we're, doing the right uh, comparable sales approach when we're trying to analyze and value this business. So it's important to know what assets are being, sold when we look at these transactions. What if liabilities are being assumed within these multiples, so we can apply the same type parameters. Again, it's asking, if these subject companies, that we're looking at, or the transactions, are their customer list being sold, or the business list being sold, or did they even buy the subject company buy any customer list in the past? And if so, what did they pay for that? What was the value of that customer list versus, what they paid? So we want to ask about those questions as well. Okay. And then, of course, the result of all these private transactions we're analyzing provide us an array of pricing multiples. So we touched upon it basically. This can be the purchase price to revenue multiple or percentage, or price to net income, or price to earnings before interest, taxes, depreciation, amortization, or otherwise known as cash flow, or looking at the owner's discretionary cash flow, adding back, what's the price compared to the real cash flow of the business, the profits plus the salaries and any perquisites we adjust to see what multiple that use. The question always becomes is, which is the proper, pricing multiple to use? Again, it's always going to be dependent upon the business that we're valuing or the industry. Some, industries where it might be more relevant to look at revenue. Again, maybe being like a restaurant where if your business is always bringing in $1 million a year, but yet, cash flow and profits change each year. That could be due to mismanagement or poorly managed or great management. But the guarantee is that there's going to be $1 million coming in the door every day. So maybe that's a little bit more relevant. But again, it depends on the industry, depends on the business, depends on the, what we're valuing. But in most cases, an earnings-based multiple does provide the best indication of value because, as we always say, industry-wise here, cash is king, cash flow is king. What am I buying? What am I putting in my pocket? What is the buyer, and maybe that's the right multiple, because when we look at revenue-based methods or multiples, there might need to be some sort of adjustments, and we'll touch upon this in an example. But maybe there needs to be a downward adjustment because maybe the profit margins aren't there. But on cash flow, it's cash flow. The indicated value under a private transactions method is control marketable, because again, the databases and the transaction we're looking at, usually it's a controlling shareholder or owner, 100% of that's selling their business. So the indication is that it's gone through all of that, they own 100%, so it's control, but the marketable side of it is that it's already factored in all of the elements of what the market's saying. So that's the indication of value. Okay, so again, to provide an example of what we see as analysts, this is basically a report that we would pull out from our databases. Again, and this one was a restaurant where we were looking at, we wanted to define the SIC code 5812812. That's right there. This is telling us, we put that as our parameters in our search database that we want, eating places. That's what the SIC code is for. That we wanted sales transactions between looking at the last 10 years in this example, because I think that's a little bit more relevant, especially with COVID and trends in the market. And so we felt that maybe in this model, I want to at least do a 10-year analysis. Our subject company maybe had $1 million in sales, so I wanted to stratify all the transactions between 500,000 and 1,500,000 to, again, try to find companies similar in nature. Again, the market approach is a great, tool, but as many experts might tell you, it's hard to find a true exact comparable, because again, geographic locations, operations, maybe the niche, especially for like restaurants, you could have Italian restaurants, seafood restaurants, steakhouses, limited service, full service, many things come into play. But again, this is just used as our first pass on a guidance to say, well, what is this value? What's the parameters? So in basically of all the transactions we've pulled, it pulled 478 transactions of restaurants and food service businesses in the SIC code between these dates. So the MVIC just represents market value of invested capital. That's relatively the purchase price of the business, maybe including some other things like cash items. Comparing it to the sales is telling us that of these 478 transactions, it's spitting out about a 31% median multiple or harmonic mean of 27%, or weighted, harmonic mean 35%, or is the average. But typically we like to look at the median because that cover picks up the highs and lows and cleans that up and doesn't get skewed by those. So in this model, let's say, for example, we'll say, okay, well, restaurants are 31% of revenue. That's a good, multiple. Or, based on cash flow, maybe we want to look at, sales discretionary earnings again, which is the profits plus the owner's compensation, and then maybe perks we've cleaned up for normalization, that it's 1.9 times that cash flow number. Other things we look at in the market approach is, okay, of the transactions we're analyzing, well, what was their profit margins? Because we got to compare it to our company. Maybe our company's only profit margin is 10%, or maybe it is 17%. They're saying after the analyst makes all their adjustments, that number should be 17% of the revenue. So if we're doing $1 million, that should be 170,000 in there. And if our business is in line with that, then I can maybe not have to adjust these multiples. But that's all we're trying to look at from this database we look at of information we're pulling. And there's other sources we rely on as well.
Hey Joe, can I jump in just 1 second? I have a question for you, and just for the audience who are here, if you have any questions at any point, please feel free to submit those questions in the Q&A tab down at the bottom of the screen. But Joe, so what's the difference? You mentioned SIC code. For those who might not be familiar with that, could you explain what that is? And the only reason I ask is because in our slide we show MVIC, which is market value of invested capital. So I didn't want anyone to get confused.
Okay, well, SIC stands for Standard Industrial Code. It's what it's the IRS, or I forgot who was the authoritative on establishing in these industrial codes, so they can be classified by industry. So 5A usually falls into retail, and then the 112 might be for the specific. There's also things you might hear of the NAICS code, the North, I forget
The North American Industry Classification System.
Yeah, so that's been like the successor of the SIC code, we'll call it. So again, it's for analysts or anyone who's on top of tax returns, they'll put these codes, and it's just basically identifier to the information, to the industry that this your subject company might be involved in. Okay, so let's go to the next slide. So how does these multiples apply in practice? So this is just a very, very raw, simplified version. But let's say I have my subject company's sales are 500,000 a year in gross. If I apply that 31% price to revenue multiple, it's going to spit out an indicated value before working capital and debt about 155,000. Similarly, if it had about 82,000 in cash flow, which is roughly almost 17%. Let's just say I'm giving you the most perfect model possible that everything's tying in. And using that 1.9 cash flow multiple, my indicated value, again, before working capital, which is cash minus its current assets, less any debts the business might have, is 156,000. So the reason why we make these bottom adjustments after the indicated value is because, again, when we talked about the asset sale versus stock sale, in this business, if I'm buying the restaurant, I'm buying it's basically its brand name, its reputation, its lease, its equipment, but I might not be buying, other things. I'm not buying the cash that business had, so I have to infuse my own cash to put it in. But this is now we're doing it for a specific owner or per individual, like the seller's point of view. Maybe the buyer will pay this 155, but at the end of the day, what's the seller going to net? Because he's got, he's going to walk away with his cash. Or her cash, and then they're going to have debts they're going to have to repay. So this will be the net number. So that's why we know the difference between either an asset sale or a stock sale. If it was a stock sale and you're buying into the business and everything's going to keep forward, this might be the value.
All right. So let's get on to the guideline public company method. So unlike what Joe just went through with the transaction method, which is based on transactions of private companies, the guideline public company method is instead based on publicly traded companies. So every publicly traded company is traded at a certain stock price. That stock price is driving the value of that public company. The public companies all have revenues and cash flows, and based on the value of the company, based on its financial metrics like revenue and EBITDA, things of that nature, valuation multiples can be gleaned from the public companies based on what they're trading at as of a specific date in time. We go to numerous sources in order to get all of that information, right? What's the company's enterprise value? What's the company's revenue? We go to Tagnify. There's other sources called more household names like Capital IQ or PitchBook. You also could go directly to the SEC filings themselves. So, what Tagnify, Capital IQ, and PitchBook, what they essentially do is they take all of the 10Ks and the 10Qs, which are annual and quarterly filings of the public companies, and they extract the data from there. They extract the last 12 months revenue. They extract the last 12 months EBITDA. But what those databases also do, which is a little more difficult for the average analyst to just go and do on their own, is they also compile forecasts for these companies from different analysts. Okay, so you have like Morningstar and even Bank of America and all these different all these different institutions. They have their own analysts that are forecasting out, what they think these public companies are going to do. And the public companies trade on those forecasts. They trade on multiples of future earnings. So Tagnify and Capital IQ and PitchBook, they actually compile all that data very nicely and they put it into one nice database for you. So just getting on a little bit more with the guideline public company. So does the guideline public company have to be an exact match to your subject company? Well, the answer is no, right? And that's because publicly traded companies, they're typically huge and they typically have multiple streams of revenue, right? They've diversified over time. That's why they're publicly traded and have hit the stock market at that point. So it doesn't have to be an exact match, but it does have to be a pretty good match, right?
At least within the industry.
Exactly. They should operate within the same industry. They should have the same general business. Their main business should be the same, even if the guideline public company has some other niche operations that it has. How many guideline public companies is appropriate? Well, Joe just showed you a slide with over 400 transactions that he used in his transaction method. So, are you going to find 400 public companies that are comparable to your subject company? No, you're not ever going to find that. So, how many is the right number? Well, in an ideal world, a lot of the treatises say you want 6 to 8, right? There are treatises that say you can go as low as 2. But if you're going to use only 2 guideline public companies, you should really be supporting your guideline public company method with another methodology, say under the income approach. And those methods should support each other. In which case, then you can say that 2 companies was okay, and you were able to tie it into another valuation approach. But again, 6 to 8 is ideal. Some of the treatises say, you can go up to a dozen. My sentiment on that is I stress quality over quantity. You don't want to just throw stuff at the wall just because it may operate within the same industry. You really want to bore into the 10Ks and the 10Qs and get a sense of what that business does and boil it down to the most comparable company. So that's my little spin on that. But once you do select those public companies and you do glean those multiples, do you just use the multiples just at their face value? If a public company is trading at 1.5 times revenue and 10 times EBITDA, do you just go and slap that onto your company? Well, no, because there are many different factors that affect the way each public company trades and your subject company experiences those different factors as well, right? So, an example of that we have here on the slide, profitability. Is your subject company as profitable as the public companies? Are they more profitable than the public companies? Do you have to consider that in the multiple that you select? How about the growth prospects? Are you valuing an early stage growth company that's growing 50% year over year, but the public companies that you have gleaned are growing at 10% year over year, that matters. Or conversely, are you looking at an industry like the semiconductor industry that grows 30% year over year, like Nvidia and AMD, and you look at those stock prices, and they're always uh, going crazy year over year, but you have some sort of a semiconductor company that you're valuing and they're growing 5% year over year. Would you apply Nvidia's 30 times revenue multiple? No, you have to factor in those growth prospects and growth expectations, and you have to adjust the multiple commensurately. And the last adjustment that I'll mention is for risk factors. A lot of times with our subject companies, we're looking at key man risks, right? And once you get to the public company level, unless you're talking about, an Elon Musk to Tesla or a Warren Buffett to Berkshire Hathaway, typically that key man element, it's not as apparent within the public company. So just things, food for thought, things to think about. Um,
Trends are a big thing too. Like talking about NVIDIA, I was just thinking, during the post-COVID when cryptos became big and everyone was trying to buy, processors and hard build up their own little service, do mining for crypto. It became a very hard to find hardware and software in these companies. And companies like NVIDIA, shot up in
exactly.
value because their products were in demand. And they couldn't supply it. But the point is, like, you also look to certain trends in certain of these public companies. If there's especially in the multiples, you'll start seeing that an analytical point of view, but again, be mindful of that as well.
Absolutely. I'll just briefly talk about enterprise value versus equity value multiples. So when you're getting information out of the databases, just apples to apples, you want to make sure that whatever you're using it for within your valuation model, you want to make sure you know if those multiples are deriving an enterprise value or an equity value. Because if it's deriving enterprise value, there's other adjustments you have to make, right? You have to add the cash, you have to subtract out the debt, and then you get to the equity value, which is really what we're valuing. We're valuing the equity within the company. So the multiples that you get out of the databases, it's always important to, make sure that you're aware of exactly what that multiple represents, enterprise value or equity value. So, what are the pros and cons of the guideline public company method? Well, one pro is that the guideline public companies give you some real world data, right? It's actual market prices, and they're as of a very specific valuation date, which is a pretty accurate measure as of that date, right? Joe mentioned COVID earlier and why he used a 10-year time horizon in his transaction method, and that's to mitigate those sort of fluctuations in the market, right? But at the same time, you're also valuing the company as of a moment in time. So, what the guideline public company method allows you to do is extrapolate multiples based on what the companies are trading for in the current market conditions. So it's a more accurate measure of value, if you will. Every industry experiences different periods of growth, different levels of risk. So the guideline public company method, it helps you understand the industry in addition to just deriving multiples to apply in the valuation. Some cons with the guideline public company method. Well, we mentioned it earlier, could be a lack of comparability, right? The public companies, they offer differ significantly from the subject company in terms of size. How about their market reach, their product diversity, their access to capital, should they need it? So it makes those direct comparisons with your subject company a little more difficult. And it's important to know, lastly, that the guideline public company method derives, we call it a minority marketable value. So, why a minority value? Well, the multiples from the guideline public companies are dictated by the price which the stock trades at, right? And that's what drives the company's enterprise value. That stock price is driven by minority shareholders that buy and sell the stock. If you go and buy Apple stock, you're a minority shareholder in Apple. Okay, so it's important to understand uh, what value indication you're getting from the guideline public company method. Because a lot of times, especially in our matrimonial cases, we're valuing, one man shop, and that could be a, 100% interest. And that's not a minority, right? That would be a controlling interest. So always important to understand where you're at with the valuation, what indications of value you're getting out of the multiples. And then marketable. Why do we call it a marketable value? Well, guideline public companies don't have the same illiquidity that a privately held company would have, right? So guideline public companies are purchased and sold at a moment's notice. And the investor does not have to factor that into the value when they're deciding what they want to buy that stock at. So that's why we call it a minority marketable value. I'm going to go through a few slides quickly in the sake of time, just to show you how we implement. Uh, Again, this is a uh, demonstrative, if you will. Okay, so in this case, we went and grabbed our public companies. We found 8 of them to compare to our subject company within the industry that we were analyzing. Okay, so we use a database called Tagnify. This information all comes from Tagnify. Okay, they give us the enterprise value, the last 12 months revenue, the next 12 months revenue, same thing for EBITDA, the margins, the growth. That all sort of comes right from Tagnify. And I say it sort of comes from Tagnify because we could go to the 10Ks and 10Qs ourselves and get all this information, but Tagnify organizes it, Capital IQ, PitchBook, same thing. So what we do is we take this data and we derive multiples based on that data set. Okay, so we have our 8 public companies. We have the last 12 months revenue, next 12 months revenue, last 12 months and next 12 months of EBITDA. What multiples based on what these public companies are trading at, based on what their values are, based on what their revenues are, based on what their EBITDA is, what multiples are they trading at? And that's exactly what we derive on this slide here. But now that sort of goes back to a question I mentioned earlier when I said, do you just take the multiples that the guideline companies give you? In this case, it's 1.16 times last 12 months revenue, so on and so forth. Do you just slap that onto your subject company? Well, of course not. We do a little bit of analytics. Okay, we compare our subject company to each of the comps in all of these key metrics, and we look at where do they fall in the pecking order. Well, our subject company here is much smaller in terms of revenue. They're at the low end in terms of EBITDA. They certainly are at the low end in terms of revenue growth. But in terms of EBITDA growth, they actually grew significantly in the last year relative to the public companies. But on a go forward basis, they actually should be right at the top. So in this case, in terms of EBITDA growth, they're growing that EBITDA. So what that means to us is they're slowing down their revenue growth. They're growing their EBITDA. This sounds like a company that is sort of reaching its maturity point in terms of its life cycle, right? They're expanding margins, they're shrinking their revenue growth, and they're stabilizing. Okay, so not to get too complicated, but this is just an example of how we would take the median multiples, which let me grab my laser pointer here, which are presented right at the top. Okay, in this case, illustrative example, we adjusted for profitability. We also adjusted for the difference in growth expectations and risk factors specifically attributable to our subject company relative to the guideline public companies. Because that's what in under fair market value, willing buyer, willing seller, a willing seller is going to be, I'm sorry, a willing buyer is going to be interested in, what are they buying relative to the market? In this case, they're buying a company that's slightly less profitable than the industry, but they're also buying a company that has a decent amount more risk than the industry. So based on that, we adjust the multiples, and then these multiples get applied right in a valuation method, uh, very similar to what Joe showed you earlier. I'm just going to zoom in here if I could. Okay, so we're taking the subject company method metrics. We're applying each of those multiples that we just derived. Okay, and now we're coming to an indicated value for under each individual multiple. Now, in this particular case, as you can see, I'm applying equal 25% weighting to each of them. That's not always the case. You should have justification for why you're applying either equal weighting across the board or more weight to others. If you have an early stage startup company that has no EBITDA, that has no cash flow, right? You're probably going to apply 0% weighting to those EBITDA multiples. And that's because that's simply not how those companies trade, right? Early stage startup companies, they trade based on multiples of their revenue. And that's going to be the more important metric to look at for that. So that weighting will be a little bit different. In this case, like I said, we're at stability. Every single valuation indication is no reason to look at one more strongly than the others. So what we end up is with an indicated enterprise value. You make your adjustments to get you down to the equity value. We added the cash. We subtracted out the interest-bearing debt. We have a typo here. This should be indicated equity value of a 100% interest. And that's how we implement the guideline public company in a nutshell. So now Joe's going to talk to you guys. I mentioned discounts earlier, valuation discounts. Joe's going to get into that in more detail now.
Okay. So after we usually arrive at our indication of value, now it comes into what interest are we valuing in the company? So obviously, if we're taking 100% interest, we value 100% of a company, there's no issue with respect to minority interest or lack of control because the 100%, shareholder controls the company. So when we value in a minority interest, what's the definition of that? Well, it's the minority interest is characterized by lack of control. And not often, sometimes the percentage, but the surrounding interest itself. A minority shareholder doesn't control key decisions such as the sale or merger of the business, or if it wants to dispose of assets, or execute agreements, or encumber the business with debt or any other financing decisions. So obviously. Those elements would have less control, less value than a pro rata interest of a controlling shareholder. So, but again, going back to that, what's a true minority interest? Is it based on the percentage? Typically anything less than a 50% interest would represent minority interest, but that's not always the case because we have to understand the business structure. So when you're valuing a company and looking at the subject interest to value, and let's say we're retained to value a 1% interest in a company. My first question is, well, does that 1% have all the voting rights? And does the 99% rest of the shareholders, maybe it was some sort of grat or decisions through gifting through the years, that the 1% shareholder still has all the control of the finances, the operations, the direction of the company, and the other 99% is maybe his kids are owners by paper only. Does that have interest, and what's documents that are surrounding that? Again, if the shareholders agreement basically lays that out, that your fractional interest has all the voting rights, has all the controls, maybe it's not applicable to apply a discount for lack of control. On the contrary, sometimes we look at the other ways. Again, we want to look at these agreements to see what's being represented, who controls the company, who controls the cash flows. So if that's the case and we're valuing a true minority interest, a discount for lack of control would be, applied. The next slide. So to determine the magnitude of a lack of control discount, what do we look at? So we look to different studies, one being the FactSet, which was formerly known as Merger Stat Review, which looks at, premiums that are offered in transactions across industries. So what does that mean? It's basically in certain industries or businesses or public companies, or an acquisition occurs, someone's buying a controlling interest or acquiring a controlling interest in the company, they will pay usually a premium for that. So the inverse of a premium becomes then our lack of control. So we look at the different studies for different industries by year, we can see what was the annual average premium paid to obtain control of these companies that they were acquired. And it tracks that. So let's go to the next slide.
Sure.
Sure. So looking at that publication for like FactSet, if we looked by a year, every year it provides us the information of what the average premium that was offered for each year. So in 2014, the acquisitions that we were seeing, control purchases, there was a 42% premium over those prices. And it looks like it's pretty static, some fluctuations each year. Maybe 20 was the COVID year, had some impact. 23 was a little up again. But we would take these control premiums and convert it to a minority interest discount based on the formula, 1 minus 1 over 1 plus the control premium. So applying that formula would then give us an indication of what a discount would be for the minority interest portion. So again, looking at those different trends, we would look at the different averages between the median and the regular straight average. And it's telling us that, if for a minority interest position in a company, usually a 25% discount would be applicable or supportable to be applied. So let's go to the next slide. Oh no, let me go back to distance. So again, what does that mean? So if we're going back to our, interest, and then we're going to talk about how these get applied later on. The first discount that should be applied if we're valuing a minority interest, a true minority interest by definition, percentage, and you would take that indicated value that we arrived at, went through either private transactions or guideline company method, and then subtract for that 25, in this case, that 25% discount for lack of control. So again, a prorated value of that interest is going to have less value due to those elements of lack of control.
The second and last valuation discount that we will discuss is the discount for lack of marketability. So at its simplest explanation, discount for lack of marketability simply relates to the fact that when you're valuing a privately held interest in a business, that is an illiquid interest. So what does that mean? If you own Apple stock, you can go to your Fidelity account, your Merrill Lynch account, whatever it may be. You need cash today. You execute a sell order and you have cash within that moment. When you own an interest in a privately held business, you simply cannot do that. And therefore, privately held businesses are inherently less valuable. So how do we come up with the appropriate discount for lack of marketability to apply to our specific our specific interest that we are valuing? So the first area that we go to is restricted stock studies. But before we even get to that, the first area that you should always look to is the operating agreement, or whatever you want to call it, the LLC agreement, the shareholders agreement, whatever that governing agreement is amongst the owners of the business, because a lot of times those agreements actually lend themselves to restrictive provisions on transferability. Not only restrictive provisions on transferability, but also rights of first refusal. You have to offer it first to the other shareholders for 30 days and then to the company for 60 days. That all creates a time lag, and that time lag creates more illiquidity for that particular interest. So that's one factor. So a second factor is what we call restricted stock studies. So let's explain that for a second. So typically, restricted stock is typically given as a stock award. It's typically a form of compensation to employees, or it could be a bonus to employees of those publicly traded companies. That stock that is awarded to the employees, it cannot be sold immediately. Therefore, it's restricted. That restricted stock is subject to a certain holding period, which I'll get into in a second. That holding period is a liquid feature that makes the stock inherently less valuable than its unrestricted counterpart that is selling freely in the open market. So again, we'll use Apple as an example. If you get, Apple stock, as if you're an Apple employee and you get, compensation in form of Apple stock, it's restricted. Your restricted Apple stock is inherently less valuable than the Apple stock that is trading freely on the open market. So important to know that someone could actually still sell their restricted stock in the form of a restricted stock. Uh, but that restricted stock is sold at a discount to what its unrestricted counterpart is trading for. So the restricted stock studies, they measure what those discounts are based on actual transactions of those restricted stocks for a certain period of time. So a little history lesson. The Securities Act of 1933. It's a federal law. It requires companies that are offering new securities to the public to register with the SEC, the Securities and Exchange Commission. In 1972, the SEC adopted Rule 144 under the Securities Act of 1933. Rule 144, in many, many words, and I'll boil it down, essentially says that the holding period for restricted stock before it can be monetized or liquidated or sold was 2 years. That held for quite a long time, but it has since been amended from that 2 years. In 1997, the SEC relaxed those restrictions down to a 1 year holding period. Now, that relaxation of restrictions that affected the discount on those restricted stocks because you didn't have to hold it for as long of a time. So the difference between the value of a restricted stock and unrestricted stock shrunk. In 2008, the SEC further relaxed that restriction to 6 months. Therefore, the difference in pricing between restricted stock and unrestricted stock further constricted. So if you look at the restricted stock studies over time, starting from the 70s, going through the 80s and the 90s and the 2000s, all the way through to today, they have decreased from discounts in the 30s and 40% in the early days of 2 year holding periods to now it's in the mid teens, 15%, based on a 6 month holding period. Now, that doesn't mean you just use 6 months across the board on every single one of your valuations just because that's what the new restricted stock studies. What this does is it provides a framework for how much of a restriction or how much of a discount should be used based on the restriction, right? If you have a private equity interest that can't be liquidated for 5 years because it's, tied up as a result of the agreements for that private equity fund, you're not going to apply a 15% discount to that, right? You're going to apply a much steeper discount to whatever valuation you're imparting on that person's interest in that private equity fund because they can't do anything with it for several years. Whereas if you have, a privately held business, 100% owner who doesn't have any other shareholders to go through, the holding period or the time horizon to sell that interest is going to be significantly less. Maybe it will be 6 months. Maybe it does equate to a 15% discount for lack of marketability. So these changes over time give a framework for how to implement the discount for lack of marketability. And the last factor to be considered with the discount for lack of marketability, there's a IRS case. It's from 1995. It's called Mandelbaum versus Commissioner. In sum and substance, Judge David Laro, who was presiding over that particular case, he came up with a framework essentially for how the discount for lack of marketability should be considered, right? And he came up with I believe there's 9 factors here. Okay. So there's 9 factors that the valuation analyst should consider in determining the magnitude of the discount for lack of marketability. I won't go through all of them. They're all listed here, but I will say that there is a significant overlap between these 9 factors and the factors that Revenue Ruling 5960 says that valuation analysts should consider in the business valuation anyway. Now, these 9 factors, according to Judge Laro, should be considered through a different lens, through through the lens of a marketability discount and how it affects that. But it's important to know that especially if you're doing an estate valuation, or gift tax or anything of that nature, that the eyes of the IRS see these 9 factors as important and material to determining the discount for lack of marketability. So now Joe will just show you how we actually apply
Sure.
these discounts.
Okay.
And
I always get the easy part of the presentations. Okay, so following the application, we had our indication of value, and again, discounts need to be applied consecutively. And sometimes that, for non-analysts, sometimes that gets a little confusing, but we're going to walk through what it means because people like to throw out discounts from value, but this is how technically it should be applied. So you would have your indicated value of 100% interest. So let's say now we're valuing a 15% minority interest, non-voting stock. So again, the prorated value would be 75,000 based on the factors we talked about. Lack of control, can't effectuate a sale, has no control over the cash flows, can't determine distributions. It's a true minority interest that, based on the studies that we're looking at, what's applicable and reasonable for a discount, 25%. So that's the first reduction. And that will bring now our indicated value from here. We're assuming it's value on a controlled marketable basis. Now we're down to a value on a minority marketable basis. Oh, let me put my highlight. So I assume the laser part was on. There's 56,000. So that's the indication of value there. But again, now let's factor in marketability factors, the time horizon, of everything that Lou talked about, the different factors, the 9 factors, and the ability to liquidate. So that additional 15%, is based on the restricted stock studies we see, maybe as a current valuation. They're not as high as they used to be. So we just determined the 15% was applicable. That becomes a further reduction to get us now to with a fair market value. There should be 15% interest, not the 25, I have a typo, on a minority non-marketable basis. So what that means overall is the effective overall discount from value is 47 divided by the 75,000 is a 36% discount. So, a lot of times in different tax court cases or analysts, they might be, carte blanche and say, we took a 30% combined discount, which is based, but the proper way to present this, whether it's for litigation, for IRS purposes, is to break out the components so that it could be, supported and or challenged. But that's the consecutive. You wouldn't take marketability before that. You apply it in this fashion to get to this discount. So overall, when we're evaluating this business, 36% falls within our, sometimes we'll call sanity check. It seems reasonable based on the factors and circumstances of this particular interest we're valuing. But again, case by case, project by project, it differs. There's no hard, fast rule that it should be 25% and 15% in all cases. The analyst should, weigh all the different factors we discussed today in arriving at these different conclusions.
And the last thing that I'll leave you with before we break, in this case, Joe is presenting a 15% interest. That's less than 50%, which on the surface, you say to yourself, okay, well, that 15% interest lacks control because it's less than 50%. It's also important to understand the control features within a particular company, right? You could have a partnership where the general partner owns 1%, but the general partner exhibits control over the decision making for that particular partnership. So even though you're valuing a 1% interest, is it appropriate in that instance to apply a discount for lack of control, given the fact that it's a general partner interest that has those control features? So it's not just a unilateral across the board, 49% or less equals, apply that discount for lack of control.
And one other thing is, what's very important, is the standard of value. So here we're discussing fair market value. So if this happened to be a shareholder dispute in New York where maybe we're valuing a 25% interest, well, that's, the courts say do fair value where you don't apply minority discounts. But, that 25% interest, even though it has no value, could effectuate now a shareholder dispute. I'm not a lawyer, I don't want to get into the legal parts of it, but when we do valuations for fair value, the marketability discount now goes out the window. So again, also when in the beginning of valuation or something before taking discounts, know the standard of value that's going to be applied in that case, because that also is very relevant to the final conclusion.
All right. With that, we are done. Steve, Sammy, do we have any questions in the queue?
We do.
All right, let's get to them in the next 3 minutes. And then if you guys have any other questions, please feel free to email us. Or you can email David Grownick and Maida Kramer, whose email addresses are here on the screen.
So we'll do this really quickly. If you are valuing a control interest in a company, but using guideline company method, which you said was on a minority basis, how would you reconcile the two? Is there some sort of premium you would add? Would you adjust the multiple?
Can you repeat that one more time?
Sure. If you're valuing a controlling interest in a company, but when you use the guideline public company method, it's on a minority interest basis, right? So how would you reconcile the two if you're valuing a control interest, yet your comparables
Yeah.
are valuing the company on a minority interest?
Yeah, absolutely. It certainly would be reasonable to apply a premium in that interest if you're valuing a control interest. And there's Joe actually went through it, that merger stat or fact set, they're actually deriving premiums, which we turn into a discount for lack of control, but you can look at it in the other way, and you can also determine premiums that you can apply. If you're reconciling it to other methodologies, such as the transaction method or under an income approach, and deriving uh, a controlling interest through there.
There's also control adjustments to cash flow, which come into play as well.
Yes, exactly.
So the answer is yes, we reconcile it by adjusting the multiple, sometimes making some other adjustments as
You
well,
could
right?
adjust it through the multiple, you could adjust it through the cash flows. Exactly.
Yep.
So Peter Mahler asks, what's your view on applicability of discounts for lack of marketability to controlling interests?
Well, we do factor that in sometimes, and I think there is some, arguments to be made with that. And then the way we approach, when you value a control interest is, marketability factors do come into play because if they were to sell the company, there might be transaction costs that would be applied, or again, basic time value of money, the time it takes to liquidate that. So typically, again, if it was 100% owner and they're trying to sell the business, they're gonna have to incur legal fees, appraisal fees, whether it's broker fees on top of that. So we try to compensate for that, saying, okay, even though we can't tie it into restricted stock studies, because of the minority interest in it, this is a controlling shareholder, that there is an element still of marketability that could be based on the industry that business specific industry is in. But the transactional cost is really what we'll try to base it on. But the discount will be much lower, it could be in the 5 to 10% range. But that's usually the justification of why you're taking a lack of control, marketability on a controlling interest.
And I'll just add just quickly to that, a controlling interest in a privately held business, it's still illiquid. There's
Yeah.
still a level of illiquidity that needs to be accounted for. It's not to the degree of a minority interest. So if you take all things equal within the same company and you're valuing a controlling interest and a minority interest, yes, the controlling interest is inherently more valuable, but that doesn't necessarily mean that you disregard a marketability discount altogether.
And let's do one last one. I know we're short on time. In the matrimonial world, parties may be intimately aware that their spouses are not reporting their complete income on their taxes or depositing the cash into accounts, so it can be
Really?
traceable during the discovery process. How do experts like KLG help expose this hidden income, and how is this reflected in the final valuation reported to the court?
Well, that's a totally different topic. We absolutely, we normalize cash flows all the time. We use tax returns in our valuation models as a starting point for the valuation. Uh, but from there, there are adjustments to be made, and we review what are called general ledgers for the businesses. And we go through those general ledgers and we determine how are the numbers on the tax returns derived? What is underneath those numbers? What transactions make up those numbers? If those transactions are personal in nature, then they get removed. Removing an expense increases income and therefore increases the value. So that's how we go through that process.
I mean, there's other forensics we do, like look at bank statements for cash businesses, at deposits equal, and tax returns.
Absolutely.
One of the always questions I always ask, which usually with very limited success, is do you have a second set of books? That you'll be able to provide. Maybe in my 30 years of doing this, handful of times that someone says, yeah, sure, here they are. But I'm telling you, but that's, we have to make the inquiries, we have to do it. This is why, we'll let, if we're neutral, we speak to both sides, try to understand all the issues and circumstances in a case, whether it's a shareholder dispute, the same thing. Is one party gonna accuse of the other one of the numbers aren't clean, you need to clean them up first. Having normalized earnings, cash flow, balance sheets is the foundation for what we do. So as a forensic accountant as well as business analyst, that's our first step. We need to make sure that we're relying on the best numbers possible. Whether if that means we have to do forensics in a case to clean those up, we will. But that's the foundation for what we do.
Well, thanks, Joe. Thanks, Lou. And thanks, everyone, for joining us today. We really appreciate you spending your time with us. Be sure to join us next month for next month's KLG webinar, topic to be determined. But we will be promoting it on LinkedIn, and you'll probably see it in an email. So if you'd like to join us next month, please do. Thank you again for joining us today. And with that, we will say goodbye.
Thank you.
All right.